All right. Well, no, thanks so much everyone for joining. That's I wanted to give you guys a quick training on 5% down construction loan. So this is a newer product that we just got released with one of our top lenders, and it's a pretty unique product just because it's a small down payment and allows you to finance the land with your purchase, and allows you to do a new construction build, which I know with how little housing we have right now, this might be a good fix for some of our clients. Um, so benefits of this one-time construction is it applies to VA and conventional loans. It's a combination of the actual construction loan and then eventually will adjust to a permanent mortgage. Traditionally you have to get that construction loan and then do a construction to permanent refinance. So usually it's two transactions, two closing costs, two loans. And usually that construction loan is almost like a hard money type loan. So this is a good option for allowing you to get those funds all at once and just do it all together. The other thing too is the funds will be accessed through a draw for the contractor. So anyone who's done one of those rehab loans in the past with FHA or conventional might be familiar with these. This is when you're going to have a part of those proceeds set aside for a contractor to pull from. And on top of that, the contractor will have to go through an approval component. So there's a form we'll have someone fill out. That contractor would then, get approved by the lender, make sure they're, a reliable option, that they have all the licensing, all their insurance, everything that they need to be able to, do this build and make the lender feel confident that they're, a solid builder. So we'll start off with the benefits of this loan. The benefits are that, you don't have to pay for that construction up front if you're a builder. That's a big thing right there. So if you have any contacts with builders specifically, that's obviously their biggest downfall. What we're seeing right now, with a lot of builders and large contractors offering, huge incentives, pretty much dropping price, selling off what they can just to get out from under it because they have to front all the cost, build it up. And if the market isn't where it was when they started the build, now they have to eat the cost and move on. So this right here is a good option for anyone who works with builders. The other good part of it is they don't have to reapprove. Traditionally, when you get that construction loan, you approve for the construction loan, you do the financing, you do the build, and once that build is complete, then you have to then reapply now for a construction to permanent refinance where you come to someone like myself or to a bank. So by not having to reapply, it just saves them the time, the paperwork, all the hassle that comes with, as you know, of what a lender and underwriter wants to look at to move things forward. Also, on top of that, you do go through a budget analysis with the lender. So the budget analysis is going to be a document that the lender is going to have that contractor fill out, and then they're going to also then run their own comps and see what materials are costing in the area, because obviously what it costs to build in one part of San Diego isn't going to be the same in another part, and vice versa for all across the whole state or even the U.S. So they do have that in place to make sure that your clients are protected, in the sense that they don't want them to underfund or under budget for this build. And then for you guys, the best part is you get paid before the build even begins. A lot of times you guys have to wait for the construction to be complete. It's just one long transaction, and then once it's complete, then we can get, quote unquote, sell that house. With this loan, you guys can buy the land, finance the land into the purchase, and then once everything is approved on plans and permitting, it closes just like a normal transaction would to begin that build process, and they treat that as the close date. So when that closes, you get paid on your sale. They get paid on what that build's going to be and what the sales and assessed values are going to be, and then you're done. And so now it's the part of where it's going to be those draws with the contractor and for the client to work with. So just go over a couple terms. I know most of you should be familiar with this, but I don't know how many people have worked with builders or with new construction. So construction period, that's going to be the time frame between initial draws and the closing of the construction. So that period is usually, for this product, it's going to be 12 months or less, preferably. If it goes over 12 months, they do have to requalify down the road. I'll touch on that a little bit later as I get into the details of the actual loan qualification. Now, the initial draw, that's going to be the funds that are going to be dispersed right when we close for the contractor to then begin the work and start the actual build of the property. They'll have a draw schedule, and that draw schedule is going to be an outline of increments of which funds can be dispersed. So depending on how expensive and how large of a build this is going to be, the draw schedule will be created beforehand. And that's where they'll let you know how much is going to get pulled. And that's why they'll also make sure they allocate enough funds to make sure that never is short. There's also what we call a construction draw fee. So every time there is a draw, there is a small fee for that draw. It's usually only about $250 or so. It's not very expensive, but there is a construction fee based on the amount of construction needed. And then lastly, there's the float down. Now with this construction loan, they do honor a float down. So if the financing that they secure at the beginning of this transaction and the rates at the close is lower, they will float you down to that lower interest rate. And that takes place if the borrower does qualify for that lower rate and if that completion is done 12 months or less. And feel free to stop me if I'm going too quick. That's I know I'm covering a lot quickly. I'm just trying to get to the point of where it really breaks down the loan and the parameters. I know that's usually the biggest part of this product. So I did pull up a draw schedule though, just as an example. And so this right here is what the lender has released. So as you can see, depending on how much cost there is, will dictate how many draws they're going to be providing to that contractor. So this is something too that lender is going to work with the contractor on and make sure the contractor has sufficient funds to do what they're trying to build. So if they do need to increase their budget at certain draw periods, they can talk to the lender to get that done. And that's why it's all going to be done beforehand. Now, before every draw is released as well, they do an inspection, one to make sure that the progress is on pace of what they said they were going to be. And then they also will complete the title search, make sure there's no outstanding liens, make sure all permits that have been done are correct and that they've been drawn to the property. If everything approves, then it's going to be a 4 business day turn time from that release of the draw of passing those inspections. So to go over now the conventional loan, because this is again a conventional and a VA loan product. For conventional, you can do a 15 or 30-year fixed loan. They have the 7-year arm and the 10-year arm available. This is also only for conforming and high balance. So if this were to be a jumbo purchase, so anything above our high balance limit of 977,000 for San Diego, they would have to bring in that difference. So it is a 5% down payment based on the completed construction as well as the land purchase if we need to purchase the land with this transaction. And it's a 700 minimum FICO. So again, you can purchase that land for, let's say, 400,000. And if that build is going to be 500,000, you have a total purchase of 900,000 with 5% down. And that can be on a 15, 30-year arm, 15, 30-year fixed, 7-year or 10-year arm. Now in VA loan, this is where it's pretty unique and I think a very, very, I think good product for our veterans. Now for VA, they do the same thing, a 30-year fix, but the VA, because they have no limit on loan, they do allow for that 30-year jumbo. It has to be a primary residence only. Conventional allowed obviously for a primary investment and a second home. VA is going to be just that primary by itself, but that maximum loan is up to 4 million. And again, that is including financed funding fee. And again, this can also be with the land as well. So you can buy land for $500,000, build for $1 million, and finance the whole $1.5 million in that transaction. Minimum FICO is going to be 620 for this product. And this one is not a 5% down with VA. They will allow for 100% financing. So to give you a breakdown of how this is structured with conventional. So both conventional and VA will follow this photo I uploaded, where it's the construction period. When the construction completes, it's going to go through a modification period where it modifies to a permanent financed loan. So for conventional specifically, that construction period is interest only. And again, that construction period is for 12 months. And at 12 months or sooner, whenever completion of the work is done or 12 months hits, that's when it will convert to permanent financing. And when that permanent financing takes place, that is where if you're eligible for a lower rate and rates are lower at that time, it will float down to that lower rate automatically. Now, if rates are higher, nothing to worry about. Obviously, that's why we lock. You're protected. Your rate's going to be your rate. They only will just allow you to float down if rates improve after that year-long period of build. Now, for the VA, it's a little different. The VA actually requires you to waive escrows. So they're going to make sure that taxes and insurance are paid separately during this period. Because again, we're going to do 100% financing with this VA loan. So you will have to be responsible for taxes and insurance on your own with this VA product. But as you see in bold, no payments are required during the construction period. So they don't even require the interest only. How they do this is they take those interest only payments you would make during that period and they add that into the budgeting cost of the build. So unlike the conventional loan where you have an interest only payment for, let's say that 11-month period of building, and then once it converts and construction is complete, it goes to the principal and interest on a 30-year fixed. The VA is a little different where during that 11-month build, it still takes up that time. So when it completes, as you see, it's a 29-year loan with a 1-month permanent finance. So it eats up that 11 months, but you're not making payments on it. So you pretty much are taking out a loan for however long after construction is complete. So if you take that full 12 months to build, you're going to have a 29-year fixed loan, not a 30-year fixed loan, because that whole first year will have been budgeted into the cost of the build. So now the loan modification, I want to do a slide on this just because I don't want it to get confused with what we're traditionally used to hearing a loan modification, which is usually derogatory of, you're going into financial hardship and need to adjust your financing to a lower rate. This loan modification is actually just the transaction of going from permanent financing from the completion of that construction. So during that build, while you're doing your interest only payments, if you're conventional, or no payments during VA, once that completion is done, it'll go through a modification. You have to sign an agreement from the from the lender and the client. And if it's not signed on 12 months or that construction is not done after 12 months, the lender will require the client to reapply and requalify for that loan. And they'll also hold back any final draw funds from the builder until that's completed. So again, to build this property, which I know in San Diego might be a little difficult, but again, it's all doable, is it has to be completed within 12 months, that build. If it's not done within 12 months, the borrower has to requalify and the lender will hold back any funds for that final draw to complete it until it's available and they have reapplied and signed that modification agreement. This also means too that once you requalify and sign that modification agreement, even if the construction is not done, you will start beginning to make your principal and interest payments because that interest only payment is only for that 12-month period. Now for the VA, it'll continue the no payments, but it will, same thing, eat up the time frame. So when your loan does begin, it will be a shorter period. So instead of being a 29-year fixed, it could be a 28-year and 10-month fixed payment. So that will adjust the overall monthly on there potentially. So this right here is the project approval. This is going to almost be the start to finish of how this will work. Is so you'll get your borrower and contract to sign the agreement, and it'll also of course have to match the cost breakdown that they'll have budgeted on the underwriting process. So that cost breakdown, as you see, it's the must match dollar amount in the construction contract. So not only do we vet that contractor, we also have to make sure that the budget they provide, they stick to. And with that cost breakdown, we're going to confirm and have everyone sign that they agree that this is the cost to do it. Everyone's on the same plan. And then that's where, of course, we'll have that set of plans that now that we know what the cost is, here's the timeframes we expect. Here's the cost during each draw that we expect we'll need to complete the portions of that build. And then again, that's when everyone will sign off on it, move it forward. And then once it gets to a certain point of that build, we'll get that appraisal ordered. So the lender will order that appraisal on the plans and the specs. So again, if the plans have not been submitted, then that lender will hold back the appraisal And again, that may be potentially pushing back your delivery date. So this is a very, I'd say, itemized transaction process. They really try to make sure that not only do you have your contractor, vetted, but they have the budget really in place. They have the plans in place of when you plan to do each build, and then that also too will align with when those draws are going to take place as well. So they really want this to be as streamlined as possible, because again, it's a one-time closed loan. So once you get everything in line to move forward, your build starts, your interest only or no payments for VA start. After 1 year, it converts to automatically to a principal and interest loan, and it's done. And the rates are very reasonable on these two, by the way. So I've quoted these out with a few people. So for conventional rates, we're going to be in the mid to high 6%. And once it converts, it usually will have about a 0.5% adjustment up. So if your interest only payments are going to be at 6%, then it's going to adjust to a 6.5% principal and interest bearing. And just like a traditional loan, after you've been in the home for 6 months of full principal and interest payments, you're eligible to refinance if rates are lower. And again, you will get that free float down if rates are already better at the time of completion for this new build. So to pick up where we left off, so I guess we ordered that appraisal on the delivery. You'll get the building permits to submit. And again, if this was already pre-done prior to our clear to close or prior to us approving the loan, you want to include that with the lender. They'll make sure that we get that taken care of, so that way we can include it in the prepaid information. Because in the prepaid information, you'll see it's where we're going to obviously document all costs of everything throughout the transactions, permits, materials, work to be completed. So if you had prepaid or already pre-applied for a permit and have permits pending or permits already in place for a piece of land, make sure we do include that during that transaction, because otherwise, if we don't have that prior to our clear to close, we cannot reimburse them or account for that part of the budget. And then obviously that last is draw at close. So what we'll do is we'll submit that fully completed form between the contractor and the buyer. And again, that's going to itemize all the costs, all the work to be completed. And that, of course, will then set up the draw period. Now, this is why it's a big deal to make sure we have as much detail and everything put together as possible, is because if that budget is underestimated and more funds are required, the borrower has to provide those funds out of pocket. So if it does go over budget, the borrower is on the hook for it. So that's something you always want to plan for. So reserves are obviously a big part of this. We always want to make sure those clients have those funds set aside just in case this does happen. Anyone who's been in construction or worked in this field knows there's always something unprecedented that takes place. So budgeting for a reserve and for additional funds is always a very safe thing to do. So I know I went very, very quick on this, but I just wanted to try to get as much done because I figured there'd be a lot of questions on it since it is a unique product. Do I have any questions right now or any slides you guys wanted me to go back to review?
Jeff had a question in the chat and he says, in the conventional product, are you paying IO on the payment as they occur, the total amount starting upon the initiation of the loan, or what?
So it's actually the interest only payments are going to be made on the total amount. So to use that first example I gave where you buy the land for $400,000 and it's going to cost $500,000 to build. So your total all in is $900,000 cost. Once you put your 5% down, what you're financing, that 95% loan, the interest only payments are based on that. That help, Jeff?
That starts day one before your shovel hits the dirt.
That starts day one. So that's why there's no payments obviously during the whole approval process. They told me obviously approval can take anywhere from 30 up to 90 days, depending on how long it takes for the contractor to get vetted and how long it takes for that budget piece to get put into place. So that way they have the draw schedule set up. Because yeah, again, they want to make sure they have everything allocated for, everything approved with the client, just like a normal, qualification would be, but then also on the building side, that they have everything planned. And yes, so once you get your clear to close, budgets in place, draws in place, contractors in place, day one of when that starts, that's when that 12-month clock starts and your first interest only payment will begin. Good question. Any other questions so far?
Great program. Holy crap.
Yeah, I mean it's very, very unique because it keeps costs extremely low for it to be new build construction. Again, and for it to be such a small down payment as well, I mean that's a huge win. Most construction again are treated like hard money, where you've got to put 20%
Yeah.
plus down at a 10 or 11% interest only payment, and then on top of that, you still have your closing cost, and then again you have to refinance out of it down the road. And then if there's delays, you have to then extend your hard money loan. So yeah, this product's extremely unique, especially for VA. Obviously, having no payments there, I mean that's almost unheard of. It's pretty much you qualify for the purchase, have no payments until the construction's done.
And Matt, do they allow you, and I apologize for being late. Do they allow you to build units, or is this single family?
So for right now, this is single family. So it's one unit only. They'll allow it though to be primary, second home, or investment property. But there is no limit on how many times you can use this. So they did say once you use this and construct, once your build and your completions you're done, you can turn around and then do the one-time close per loan again and purchase another investment or a second home. Obviously, if you build a primary property, the next ones will have to be second home or investment. Otherwise, you can do two at the same time if they're investment. So I asked that for a client who works with builders, and he had a piece of land already in ownership. They were actually talking to their hard money guy to get the construction loan worked out, and he had an issue with it being two individual units. And I told him as long as they split the lot and it's two transactions on two separate lots, they can do two one-time close transactions because they're both going to be investment properties. Now, investment though, I will say investment is a 20% down payment. They do treat that one as a traditional investment. So you do have to put 20% down in that situation. The 5% down is just for the primary purchases. Sissy, good question. So this loan cannot be used for remodeling with VA. With conventional, I do believe it allows for remodel, but it does have to be for, I believe, a full rebuild. It can't just be like an interior remodel or an update to a home. I do believe they want it to be a full, like a remodel in the sense of they want it to be, you're taking down the house and rebuilding the house pretty much, not leaving the walls up, because that would then qualify as the rehab loans.
Thank you so
Or-
much. Yeah, I was thinking something like taking it down to the studs like they do in coastal communities. Not much of it is left except a couple of walls, and they call it remodel to skip the coastal commission and all that, but
Mhm.
it's really rebuilding the house from the ground up. So
So
would that qualify?
I believe for conventional that does qualify. I know for VA, they specifically made a note that they don't allow for any remodel to an existing home. Conventional, I do believe it allows for what you're talking about, where you take it down to the studs and it's a remodel, but really a rebuild. That is allowed. They just don't want it to be utilized and won't allow it to be utilized for, keeping the whole house together and you're just trying to add on to the house or, redo half the home, but keep the other half the same. They want it to be all together.
Okay, thank you.
So I'll reach out just to confirm on that, but I do believe I read that that'll be allowed with conventional. Let's see. Maria, correct. No VA funding fee if they are disabled. And if it's subsequent use, same thing. No VA funding fee because their exemption with their disability will always waive that. So they'll just only be financing the purchase. ADU, a good question. They do not allow it to build for the ADU. It does have to be the primary dwelling unit. So they want it to be one unit, one property. They do, for ADU, you'd have to use an ADU build specific loan or pull the money out of the house or, financing a different way.
So they wouldn't consider that an investment?
It would, but they want when it comes to an investment, they want it to be the main home itself.
I got you.
Because with it being the accessory dwelling unit, it's technically a second unit, and so they don't want to do anything with the second unit or anything separate because they want everything financed wise to be for that property and tied to that property. Otherwise, it would technically almost be as a second loan against the first, and if that first has no mortgage, again, they're pretty much then financing a second unit on the property.
Gotcha. Thanks.
Any other questions so far? I know it's a case by case, and if you guys ever see, any land or have any clients that are willing to, take the time to go through this process, feel free to let me know, and I can always, speak with them, or if you want to talk to me outside of the Zoom call, feel free to give me a call, and we can discuss it. Again, I just saw this as a great product that was very unique. I haven't seen anything out there like this, and especially too with right now where we're all struggling with housing and not having much. I want to see that, buying land and building could be a good alternative.
Maria was wondering if you could repeat what happens if it takes longer than 12 months.
Yes, so if it takes longer than 12 months, what they do is you have to requalify. So they'll requalify you in terms of, income, documents, repo credit. And then what they'll do as well is they're going to hold back any funds that were set to be, released with the contractor. And they'll wait until everything is signed with that modification agreement. So if everything is not where it's supposed to be, they still have more time to go, and the client now is working on getting requalified. Once that client's requalified, it does not allow them to get interest only payments again. They have to go with the full principal and interest payments now at this time, even though they're not living in the home. And at that time, that's when they'll release those final draw funds. And again, if they need more funds outside of what that final draw amount is going to be, it's up to the borrower to fund that out of pocket for it. So again, that's why these can take, I've heard, 2 to 3 months on the front end side of things, just to make sure that you guys have everything scheduled, planned, as much of the permitting process done. Because I know in San Diego, that's our biggest time taker is getting the permit approved. So I have heard that a lot of times they'll almost delay the close of the loan until they have permits, just so that way when the permit's back and they truly are ready to actually start the build, that's when they try to time it to close the loan. So you're only doing that 12-month clock of interest only payments during the true building process of it, versus waiting for permits to come in and then finding out that 6 months down the road you finally get your permit and it's still going to take 12 months to build. You don't put yourself in a situation where you're paying 6 months of principal and interest payments without living in the home. All right. Anything else? All right. Well, thank you guys so much. Again, if you guys need anything, feel free to reach out with any questions. Again, I know it's a unique product. So if you guys come across any clients who want to try to use this, or you yourself have questions on how to, how to pitch this or how to work this, let me know. And, we'll find a way to make it happen.
Thanks so much, Matt. That was great.
Thank you, Matt.
Matt. It was
Yeah,
great.
Thank you, Matt.
Of course.
Thanks.
Thanks, guys.
Thanks,
Have a
Matt.
nice
That's a
day.
great program.
No,
It
it is.
really does.
That's unbelievable. I'm tempted to use it myself, honestly.
Was this recorded? Are we going to get the slides?
Yes.
Okay,
Yep.
great. Thanks.
All right. Thanks,
And-
everybody.
Lindsay, does Agent Hub
Bye.
allow me to send PowerPoint slides out or no?
Yeah.
It does? Okay. I'll put the PowerPoint in Agent Hub for everyone. And then
Great.
I think, Lindsay, you said you send out the
Yeah, I'll send out the recording. Also, send me the slides and I'll put them up in Agent Hub.
Okay.
If
Yep,
you
I
can, yeah. All right. Thanks, guys.
Thanks,
Thank you, guys.
everybody.
Take care.